making money. So the stock market right now, it remains in sort of a sell first, and let's put it this way, never ask questions later kind of mode, or never even looking for the answers kind of mode. Big problem, of course, the Strait of Hormuz really we're zeroing in because 20% of the global oil output comes from there. You can see, you go back to past situations like this, 5% came out of there, which was only 9% of the world, 4 million barrels, 6% of the world. But 20 million barrels, 20% of the world. So, obviously it's a vast increase from past shocks, but here's the rub. Here's the rub though. As far as America is concerned, this is, this part alone, let's thank the fracking miracle. We're way down at the bottom. We get 2.5%. This is more of a China, India, Asian story than an American story. Yet, of course, we're thrust in the middle of it all. And again, the fracking miracle put us here. We're no longer at the mercy of the Middle East, but the global economy is. And so, even though the price of oil is up, even West Texas Intermediate, remember, it rises and falls on global sentiment, not just U.S. demand. But I think there is a disconnect, a serious disconnect regarding the level of fear and panic that's in the air right now. In fact, a lot of this comes from the same folks in the media, financial media on Wall Street, who were predicting, rooting for economic calamity when the tariffs, remember the tariff tantrum was worse than this. And of course, it's going to be the end, and it ended up being an amazing buying opportunity. And just like the year, that year, stocks were down a lot. They've tumbled here in the last week or so. But the bottom line is the stock market is operating in fear mode. More evident, it's even more evident when you think about sort of the different gauges out there. So momentum has been killing it, right? We know momentum is the thing that's done very well. This was yesterday's session, and I thought this was so phenomenal because the hottest stocks in the market were the hardest hit. And the worst performing stocks of the year in the past year were the only ones that were up, right? So it's a sort of flip part here. Now, of course, part of the logic is you cash out these big winners, right? You're up big, why put it at risk? And then maybe you even nibble a little bit at the losers. And by the way, it's not just stocks, right? Think about gold. Gold was at 5,600 just January 31st, late in January. It's around 5,100 now, but here's the thing. The outflows are huge. The largest outflow since November of 2016. Now, ironically, this is the environment, right? This is the geopolitical environment, the uncertainty, where there should be inflows into gold. So, of course, there's other factors when it comes to the stock market. One issue is a major lack of liquidity. Look down here. Liquidity has dripped down to the point where it was, again, in April of last year. And, of course, investors are more willing participants when there's a lot of liquidity out there. You want to know why momentum works? Put a lot of cash out there. So the result is the stock market has become extremely volatile on an individual basis. In fact, I want you to take a look at this. So we look at the VIX a lot, and the VIX is elevated. It's around 26 right now. It's been as high as 30. But if you look at individual stocks have not been this volatile in 25 years, in a long time. And so when you say, man, it feels like my portfolio is in bad shape, it's down a lot more than the market, this is why. Overall, though, I feel like this is a coiled spring. We're really starting to coil up here really good. I think we'll keep strong support for the S&P well above 200. And when we get back above the 50-day, I think it will be off to the races. So the bottom line is, when this thing reverses, you don't want to be flat-footed. Now, perhaps a microcosm of all the stuff that's happening is in the tech world, right? Think about this. I showed you this chart yesterday where the tables return. Software making a powerful move, outperforming semiconductors, right? They've been the opposite way for a long time.